I am super excited about the new milestone that we reached this month, guys. We now make over $200. That's right, $200 every single day in passive income. So 365 days a year, including weekends and holidays. So once again, guys, it's time to unveil and review my entire income focused portfolio with you guys. If you're new to the channel, welcome. The mission of this channel is to help everyday normal people invest on their own in order to build their own stream of passive income to enhance their quality of life and one day become financially independent. So I don't just talk about it, I actually show you how to do it. Because I'm actually living the dream since 2019. So the video thumbnail, guys, was not clickbait. The numbers are 100% real, and I will show you my portfolio from A to Z. So I get many comments and emails from you guys telling me that you appreciate the openness, the honesty, showing my entire portfolio pretty much every single month now, something that many YouTubers don't do. Myself, on the other hand, do it every single month. So if you're watching this video, make sure you're watching the latest portfolio unveil, because I usually do an update every single month. This video is number 8 or update 8 for August 2021. So I have a YouTube playlist, by the way, dedicated to all my videos where I unveil my entire portfolio. So if you want to check that out, you could actually see my entire journey, or my journey, if you will. So just a quick reminder, guys, a quick summary of my investment strategy and a few important details before I unveil everything to you guys. So please listen to this part if you're newer to the channel, as I cover many of the FAQs here. So this should answer a lot of them. If you heard this all before, if you're a regular, you could skip to the portfolio and unveil, of course, with the help of the YouTube chapters in the description below, or in that the bar there, the time bar. So first of all, I am Canadian. So almost all the funds and stocks in my portfolio that I'm about to show you are listed on the Canadian stock market, on the Toronto Stock Exchange, the TSX. So the number one question I get from my American friends or people outside of North America is that they cannot find these stock symbols, the stock tickers. So I repeat, these are Canadian listed funds, not US listed funds. So not all international brokers or American brokers can access these Canadian listed funds. So if you're American or you invest in the in the US stock market outside of North America, I wouldn't suggest investing in any Canadian listed funds. It doesn't really make sense for you guys, because you would have to pay additional withholding taxes. Plus, you guys have the best stock market in the world at your disposal, the US stock market, either the New York Stock Exchange or the NASDAQ. So for me, it wouldn't make sense if you're outside of Canada to invest on the Canadian stock market, right? So even though you're investing in the US stock market and not in the Canadian market, you could easily replicate my strategy, my style of investing on the US market. So I do have a playlist, a YouTube playlist, where I discuss US listed funds that adhere to my strategy, the income strategy. So if you're American or outside of North America, make sure to check out that YouTube playlist, because that's where I discuss these US listed funds. So not to say that I don't invest in US listed funds. I do have 3 of them, or 3 funds in this main portfolio, but the rest I hold in my retirement accounts, which I'll talk about in a little bit. Also, I offer a digital product on my website, passiveincomeinvesting.ca, for only 45 Canadian dollars, which includes all my years of research for the best funds designed for income or growth in Canada and in the US. So there's also sample portfolios in there, guys, for Americans and Canadians. So I strongly suggest you pick it up if you like my investing style. Now, a quick note about my investing style. I am a long-term buy and hold income focused or income seeking investor. So the primary objective of this strategy is really to generate high, consistent, and relatively safe passive income via dividends or distributions every single month. So most, if not all, my returns don't come from capital appreciation or stock price upside. It comes from the income that my portfolio generates. So I know this is a hard concept for many of you to understand, because all you ever see and read in the media is mostly basically growth, right? Growth stocks, capital appreciation, buying low, selling high, whatever you want to call it. But there is another way to make money with the stock market where you don't really care about stock prices. My way, the income style. So my portfolio primarily holds funds that invest in blue chip companies, blue chip corporations, and that use income enhancing strategies like leverage or the covered call strategy. So they provide consistent income, and the intent is really to hold them long term, not to trade them or sell them later on at a profit, right? It's really to collect the passive income forever. So this strategy enabled my wife and I to become financially independent in our mid-30s in 2019. So you could check out my financial freedom video if ever you're curious to see our whole journey there. It's an older video, but the information is still valid. So my strategy might not be fun, exciting, or mainstream, but I can promise you that it works. You just need to stay focused and disciplined. Slow and steady wins the rat race. Also keep in mind, I'm not against the more popular growth strategy where you could just buy the popular passive broad-based index funds from Vanguard or iShares. And I am not against the other popular strategy, the dividend or dividend growth strategy, where you hold either single dividend stocks or dividend themed ETFs. This is simply the strategy that works best for me. Whether it's income growth or dividend growth, they all work long term. So 4 quick reminders, guys, before I show you everything from A to Z. Number 1, this is my main portfolio and is made up of a combination of 4 investing accounts. My TFSA account and my wife's TFSA account, that's the tax-free savings account, and my cash account and my wife's cash account, which is simply a regular non-registered account. So the income these accounts generate is what we use to pay all our living expenses. So the dividends and distributions are extracted every month and sent to our bank account, which means we do not use the DRIP. We don't use the dividend reinvestment plan. Also, in terms of taxes, obviously any income that comes out of the TFSA accounts is completely tax-free, but the rest, so the majority which comes from the cash accounts, is taxed, so we have no choice to pay the taxes there. But because we contribute regularly to our RRSP accounts, to our retirement accounts, and because most of these funds are very, very tax efficient, the income essentially becomes tax-free for us in the end. The RRSP, guys, is a very powerful tool in that regard to lower your income dollar for dollar. Also, if you have no salary income, a big portion of the investment income that you get from your cash accounts is immune to taxes or certain percentages. So, of course, the amount varies, the percentage varies depending on which province you live in. Number 2, this portfolio does not include our RRSP accounts, like I mentioned, right? So these are the RRSP accounts. Retirement accounts are completely separate. I have another video covering our 2 RRSP accounts in detail, even though it's very outdated, and I'm pretty much due for an update video on our RRSP accounts. But stay patient. I'll definitely make one in the coming month or 2. So as you know, these are why do I keep them separate? Why they're not included is because they're retirement accounts. So you shouldn't be withdrawing any of the money, even though you shouldn't, because it's subject to all kinds of penalties and withholding taxes. That's really designed to grow your nest egg for later on. That's why I don't touch that income. So any income in those accounts just gets reinvested manually, basically. So they're compounding. Number 3, I will quickly show you the 4 accounts, the 2 TFSAs, 2 cash accounts directly in my broker account. So I will actually open my broker account and show you, so you could see how my capital is doing, right? My account value, even though it's definitely not the biggest concern of mine as an income investor. And then I will show you my portfolio, which is the combination of those 4 accounts in an Excel spreadsheet. And we'll go through each fund one by one. I'll discuss the funds, if I made any changes, if I made any additions, etc., etc. Last but not least, guys, you could download the spreadsheet, the Excel sheet, which I'm going to show you for free on my website, passiveincomeinvesting.ca. So you just need to click on the free tools and resources link, which is at the top of the website, and it's the very first download. So I know by showing you the Excel, it might be small, but you could download it yourself and follow along if that makes it easier for you. So without further ado, let's check out my entire portfolio together. All All right, guys, so as usual, let's get started with my cash account, my non-registered account. So as you could see, the market value is just under 350K, where my book cost is 274. So right now I am up a little under 75K, so 27%. So just to show you that this is completely legit and real, I'm doing this live on August 12th at 3:46 p.m. The stock market is still open, so when I hit the refresh, you will see this number change, right? Because the stock market, basically prices change every single second. So if I hit reset, there you go. Oh, there you go, 75K. I really honestly can't tell you how much I really don't care about this number. As you could see here, this is the key here, right? Unrealized. So unreal. This for me is unreal. So this is just what your investments are worth on paper. To actually realize this gain, you would have to sell all your shares, which I'm a buy and hold investor. I don't sell anything. This is why I tell you guys, I really don't care about this number. So I definitely won't go through them, all the holdings one by one in this account here, because like I mentioned at the beginning, I'll show you everything in the Excel file, which is a combination and includes this account as well. So pretty much on everything I'm up on, right? Except for a few of these funds here. But everything, is doing really well now because the stock market has hit all-time high. So now let's quickly check out how my TFSA is doing. So here's my TFSA account, guys. It's up only $2,000, but that's okay. It's not something I care about. So as you could see, my investments are doing well. Everything is in the green. And that's just because the stock market is high. So now that you've seen my accounts, let's check out my wife's two accounts, and then I'll show you everything in the Excel file. So here's my wife's non-registered cash account. As you could see, it's also in the green, and pretty much everything is in the green except for these couple of funds here, which two of the three are actually the only speculative positions that I have. One in cannabis and a cannabis ETF called HMJU, and a Bitcoin ETF as well. So I'll show you that in a second, the whole thing anyway. So now let's check out really quick her TFSA account. So here it is. Here's our TFSA account, doing much better than my account, I would say. And you could actually see all the contents in the account as well. And once again, they're all in the green. So now it's time to show you the combination of the four accounts, guys, via the Excel file, so you could get a nice bird's eye view of all four accounts combined. All right, guys, here's the Excel file. Here is the combination of those four accounts. So this is everything, guys. And let me just go quickly explain the columns here. So the first column obviously is the name of the fund, right? The name of the stock or the fund. This is the stock symbol. You could see that they're underlined, right? They're hyperlinked. So if you just click on them, they will bring you automatically to the fund's website. So this is why if you ever want to do research on some of the funds I have, make sure to download my portfolio so you could actually click on the hyperlinks. So this is column F here. Is the details. So I like to put the sector and the region of the fund. This is my investment. So this is my how much money I put into this fund, not how much it's worth right now, but my investment. The weight, obviously, the weight of the of the fund compared to my portfolio. So the higher it is, the bigger portion. Obviously, number of shares I have. The book price per share. So this is my share price, or my average share price, not the current share price. This is also my yield, or my dividend yield, based on book price, obviously, the annual dividend. So this is the annual dividend rate, right, per share. And this is the annual income the corresponding fund gives me, and the monthly income the corresponding fund gives me. And of course, this is all in Canadian dollars. Even though I have three funds that are US listed, they're all I modified the formulas so that they all, everything is in Canadian dollars here, guys. So let's go through each section one by one. My income funds or closed-end funds, then my ETFs, then my split share funds, and I'll quickly go over my single stocks and single REITs as well, even though I don't have many of those left. So closed-end funds first, income fund. First one is my OG of my portfolio, the Canoe EIT Income Fund. This is the biggest closed-end fund in Canada, in my opinion, the best one, managed by Canoe, a really reputable mutual fund company. So this fund invests in dividend growth stocks in North America. It's about 60% Canadian stocks, 40% US stocks, a really, really nice mix. Obviously, a little bit heavier on the financials in the energy, That's what the Canadian market is. So as you could see here from the weight, it is one of my significant positions in my portfolio. I absolutely love it. If you want to know more about this fund, I have a specific video just on this fund, so make sure to check it out. The next two are my funds from Quadravest that are not split funds. So Quadravest is a manager of split share funds, which we're going to check out later on, but they actually have two funds that are not split funds: Dividend Select 15 Corporation and the Income Financial Trust. So DS focuses on Canadian dividend stocks. This is kind of like a little brother of their flagship split fund, DFN. So what I like about this one is that as well as Inc.UN is only financial stocks in North America. So it has US and Canadian financial stocks, but it's only financials, whereas DS, although it has a lot of financials like the Canadian banks, it also has other stocks like Bell and TELUS and Enbridge, etc. So what's really special about these is really the dividend policy. They have a very unique dividend policy where it changes every month, and it's based on the fund's stock price. So the higher the fund's stock price goes, the higher your dividend will be for that month. And one fund that's gone completely bonkers is Inc.UN, because it's all financials, and financials have made amazing gains in the last 6 to 12 months, right? All financial stocks have gone up. So since this fund is only financials, it's skyrocketed. So this is why I'm making an astronomical 23% dividend yield on it, because my book price is $7.57 and right now the stock is like $18. So right now this fund, even though it's doing really, really well for me and I have an incredible yield on it, I wouldn't suggest or be careful picking it up right now because it's trading at a humongous premium. So although the stock price is about $18, the net asset value, or the value of the actual fund, is actually less than half of that. It's like at $8, under $8. So just be careful with this one. But although DS is also trading at a premium, it's definitely not as big. So these two, the dividend is really based, like I said, it changes every month. It's based on the stock price, and it's actually, to find it, you apply 10% to the stock price. So if the stock price is $10, let's say, well, the annual dividend would mean it's $1, right? It's 10% of it. So take $1 divided by 12, and that will give you your monthly dividend. So I also have a video on these two funds, by the way, if you want to know more about them. Next one is the first US listed fund that I have. It's CLM, Cornerstone Strategic Value Fund. So this for me is a really, really cool fund on the US stock market, and I love it so much that I decided to get it anyway in my cash account. So I am paying a 15% withholding tax on the dividends, but the dividend is so high that I'm still making 13.43%. This is including the 15% withdrawal. So CLM really has big blue chip stocks in the US mostly, and what makes CLM special is that it has a very, very aggressive dividend policy or distribution policy. The fund manager gives out 21% of the fund's net asset value out every year in dividends. So every year the dividend is reset to 21% of what the NAV is. So it's very, very aggressive, very, very high yield. So because it gives out so much yield, if you look at the stock price, it is on a downward trend. So this is completely normal. So if you like CLM or want to know more about it, I also have a CLM video. So make sure to check it out. Last but not least, FAP, one of the newer additions to the portfolio. So this is a closed-end fund by Aberdeen, very reputable management company, and it focuses on fixed income in the Asia Pacific region. So Thailand, China, Australia, Japan. So it has corporate and government bonds. I'm not big on fixed income, government bonds, corporate bonds, preferred shares, but because this fund uses leverage, number one, it has a really, really nice yield, and because it was trading at such a big discount, it's been a stock pick of the month for the last couple of months, or the last month anyway. I picked this one up. So I'm making a really, really nice yield here. Right now the yield, since turns out I was right, the share price just keeps going up. But it's still trading at a discount. I think it's a really good pickup right now, guys, and it will add some nice diversification to your portfolio. So because I'm Canadian, I have a lot of Canadian funds and I have a lot of stocks. This is fixed income. This is different, and also Asia Pacific region, which is pretty exotic, pretty hard to reach for us Canadians or Americans as well. So that's why I really picked it up, because it gave me a little bit of diversification. So now let's move on to the ETFs, my portfolio's bread and butter. All right, so let's go through the ETFs, guys. Most of these, and by the way, there's a star next to any fund that uses a options income enhancing strategy, like the covered call strategy. So that's what the star means. So I did make a change recently with my ETFs. I did sell and got rid of ZWE, the ETF from BMO that invests in European dividend stocks. So I didn't sell it because I don't like the fund. I think it's a really good fund. It's a good way to get exposure specifically to Europe. The main reason I sold it, guys, is because there has been a dividend decrease, and it also includes ZWG, which is the a similar style covered call ETF from BMO, has global dividend stocks, including US, including Europe, including Canada. So I decided to swap ZWE for more ZWG. So I sold it and I picked up some ZWG shares. And another thing I swapped ZWE for, because I still wanted to keep some very heavy European exposure, is I put more in HUTL. So HUTL focuses on utilities and telecom worldwide, but it's like 50% Europe. So for me, it made sense to sell ZWE, put half of the proceeds in ZWG and the other half in HUTL. But if you have ZWE, guys, you don't feel pressure to sell it just because I did. Okay, so let's go through them now. ZWC, ZWG. So these are some of my favorite covered call ETFs from BMO, which basically are region specific, right? So ZWC has the Canadian dividend stocks, ZWG has global dividend stocks. So it has US, Canada, and Europe, but mostly US. So these are really OGs of my portfolio here. ZWU focuses on utilities and telecom. So this is one of my favorite defensive ETFs. I did recently add a little bit in here, so I'm up to 20K in this fund. I really like utilities and telecom because for me, everyone needs electricity, everyone needs their telecom services, right? Cell phone, TV. So this fund, ZWU, holds the top North American utilities, telecom, and pipeline companies. We're talking about Bell, Telus, Rogers, AT&T, Verizon. We're talking about Enbridge, Pembina Pipeline. There's a couple of other pipeline companies in there, but really the focus is on electricity and telecommunication. So really, really defensive. Really love this one. ZWK is where I get my US banks exposure. So this is another covered call ETF from BMO, which focuses on the big US banks. So unlike Canada, where there's only 6, in the US there's like 16 or 17 or something like that. So in here, you basically have all the top US banks. And I was lucky enough to buy it fairly cheap. This is why I'm making a 10% yield on it right now. But currently the yield on it is somewhere in the 7s, right? Another thing I want to mention is that for ZWC and ZWE, they have lowered the dividend from 11 cents to 10 cents in the last 2 months, but I think it's possible that it's still temporary. This is why I still left the annual dividend for me at ZWC at $1.32. I didn't lower it to $1.20 just yet, but if they do 10 cents a month for 6 months in a row, then I would probably pull the trigger and actually put this at $1.20. ZPH, the last one that I have from BMO, is really, for me, I consider it my safety ETF. It acts kind of like a cash savings account for me. So this ETF is unique because it uses a put option strategy versus a covered call option strategy. So the ETF itself does not hold any stocks. It makes its money by selling put options on US stocks, and everything else that it has is pretty much just short-term US government bonds or T-bills. So this is very, very safe. It's meant for safety, it's meant for stability, but you still make a nice 7% yield on it. So I think of this like my cash account, and I do have a video that I'm currently writing which will talk about this ETF and other safety ETFs. So stay tuned for that. The next 4 are from CI Global Asset Management. I love these covered call ETFs. They are very high yield. They're very aggressive with the covered calls. They do at the money covered calls compared to out of the money. That's what BMO does. So the yield is typically higher, and they do them on sector specific funds. So the only downside is that the dividend is quarterly, and it changes every month opposed to monthly. So it is a pain in the butt a bit to track the income that you make. You kind of got to update the annual dividend every single quarter. So FLI focuses on the financial sector, but no banks. It's just the North American life insurance company. So it's the top North American life insurance company. So Sun Life, Manulife, Great West Life in Canada, and then in the US you have 7 of them: AFLAC, Lincoln, Prudential, MetLife, etc. So really, really cool and unique fund, because it's rare that you have specifically a life insurance exposure. So this is why I like FLI. NXF is where I get my energy exposure. So anytime I want to invest in energy, if oil takes a dip or whatever, I put my money in NXF. So this focuses on 15 global oil and gas producers. So we're talking about only the big guys here: Suncor, Canadian Natural, ExxonMobil, Chevron, BP, Total, Shell, and some other ones from Colombia and Norway. So really only the big guys here, no junior guys. So this is where I get my energy exposure. TXF is where I get my technology, my pure technology exposure. So it holds 25 global technology giants. So Apple, Microsoft, Nvidia, AMD, Zoom, Snap, etc., etc. All the best technology companies are in TXF. You get them all with one ETF, and it has a massive yield. It's been really, really good at giving out good yield. So as you can see, this is actually my highest yield one, over 12%. Keep in mind they do fluctuate, so this 12 could eventually go down with time. CGXF is where I get my gold producers exposure. So this has 15 of the biggest global gold and precious metal giants. So we're talking about Newmont, Barrick, Royal Gold, B2B Gold, Yamana, etc., etc. I don't know them all by heart, but it's really the biggest ones here, guys. And I did drop $5,000 in this recently. This is my most recent purchase, so I did put $5,000 because materials is what's really lagging the stock market right now. It's really what's weak, and it makes complete sense. Anything to do with materials or commodities like gold and silver will lag when we're having a strong bull market in terms of stock. So this is a really good pickup recently, and I have a strong feeling that it will be one of the stock picks of the month for September. So the next two are from Harvest, another one of my favorite covered call ETF managers. The first one is HHL. For me, it's their best fund. It's their biggest fund. It's where I get my healthcare exposure. So it has 20 of the biggest healthcare giants. We're talking about Pfizer, Johnson & Johnson, AstraZeneca, Moderna, Abbott Laboratories. So all the best pharmaceutical and medical equipment companies in the world are in this ETF. And a really, really good thing about it is that it consistently has a yield of over 8%. So I have 9, but right now it's at 8. And healthcare is defensive, right? Just like ZWU and HUTL, which I'll talk about in a second. So this is why I have a nice chunk in this one here in healthcare. HUTL is, for me, ZWU's twin brother, because it also focuses on utilities and telecom as well as pipelines. But unlike ZWU, which focuses on only North America, this is global. So half of it is Europe. So you have all the top telecom and electricity companies, as well as a little bit of pipelines. There's only 2 pipelines in here. I think it's Kinder Morgan from the US and TRP from Canada. So everything else is telecom and utility. So really, really solid 7% yield here. So HUTL, ZWU, you own those 2, you own the best utilities, telecom, pipeline companies in the world. So I really like those 2, very defensive. Next one is a brand new covered call ETF fund from Hamilton ETF. So it's HDIV, and this is kind of like a dream come true for me, honestly, and it's very, very special. And I have a feeling that it's probably going to be a rising star in my portfolio, because it literally has 7, it's a fund that holds 7 covered call ETFs, and it uses a little bit of leverage. So the first dividend did not even come out yet, but it will be declared at the end of August. I'm actually in contact, or Hamilton ETFs reached out to me because I recently made a video on HDIV, and they said they really like the video. So I might do a collaboration video with them soon, I'm hoping. So let's keep our fingers crossed. So this ETF or this fund holds 7 covered call ETFs. So it holds ZWB, which has the 6 big banks, ZWU, which I already own. It has the 20 plus North American utilities companies, FLI, which I already own as well, the life insurance, NXF, own it already, the global oil and gas producer, HHL, also have that, the 20 healthcare giants, HTA. So HTA is kind of the equivalent to TXF. So it has the technology companies. And then there's also HEP, which is the equivalent to CGXF by Horizons, which has the top gold and precious metal producer. So this is really special because it's like a one-stop shop. It's very, very diversified. And it has a lot of promise because the yield is supposed to have a target of 8.5. So very, very excited about this. I put $1.40 here, but I don't really know what the annual dividend rate is going to be. So I just put $1.40 because they targeted 8.5 for now. IDR is one of the only ETFs that I have that doesn't use the cover call strategy. So this is real estate exposure, guys, that has the top REITs in North America. I prefer this to the more mainstream REIT ETFs from Vanguard, like VRE or XRE from iShares, because there's a little bit more active management and the yield is a little bit higher. So I nabbed it at 6.5, but I think now the yield is actually maybe under 6. I like it because Middlefield is a real estate expert, but Middlefield came out with another fund for real estate, a split fund, which I'll show you in a second. And that is now my go-to place instead of IDR. But I'm deciding just to keep IDR for now, even though I'm up on it significantly. The next two are my other 2 US listed funds besides CLM. So QYLD and RYLD, these are some of my favorite ETFs of all time. They're managed by Global X, the brother company of Horizons, which is all owned by Murray Asset Management, a company in South Korea. So QYLD and RYLD have aggressive covered call policies. They write at the money covered calls on a US index. So QYLD on the NASDAQ, RYLD on the Russell 2000. So check out my latest stock pick of the month. I talk about RYLD in detail there, but QYLD is basically the biggest and most popular covered call ETF on the US stock market. So very, very consistent 10 to 12% yield, but because I hold them in a cash account, I do have to pay the 15% withholding tax. So my yields are a little bit lower, 972 at 1074 for RYLD, but hey, I'm not complaining. HMMJ. So this is the only, I don't consider this an income play. This is a speculative play that invests in the cannabis industry in North America. So the reason why I actually have it here in my income portfolio is because the ETF actually provides a quarterly dividend, even though it's really, really small. So I actually trimmed the position down. I had 14K, but I reduced it to 10. So I sold a little bit, and that's really to make sure I had some money to buy HDIV because I put $10,000 in HDIV. So now let's move on to split share funds. Everyone's favorite high yield funds, right? Let's go through them one by one. All right, guys, split share funds, some of my favorite funds of all time. Split share funds are essentially, if you didn't know, they're really covered call ETFs with leverage, and leverage is what makes them different from a regular covered call ETF, right? So let's go through them one by one. The first two are from Quadravest, so they are a popular split share fund manager in Canada, and DFN is definitely their biggest and their best split share fund in my opinion, their flagship fund. So it invests in about 15, like the name says, Dividend 15, Financial 15. So they invest in about 15 Canadian dividend stocks, really the best ones, and they haven't missed any dividends whatsoever. Recently, they've only missed 4 out of 200. I'm sorry, you can't really see it here. Let me just scroll. So they missed in total, guys. The fund's been out since April 2004, and they only missed 4 out of 207 monthly distributions, which is absolutely incredible. All 4 were in 2020 during the COVID-19 volatility. So very, very solid fund for really high yield and consistency. A really good way to get high yield with Canadian dividend stocks. Financial 15 focuses on the financial sector, like the name says, 10 Canadian financial companies, 5 US financial companies. So this one had a reverse stock split back in December 2020. So I actually lost 60% of my shares because of that. But when they do that, the fund's unit NAV significantly went up. So right now, this fund is actually, I consider it safer than DFN. The unit NAV is much higher. It's over $20. So even with losing the shit with 60% of my shares, I did add a little bit of money in here in earlier in the year. I'm still making a 10% yield, or almost 11, which is absolutely incredible. So this guy did miss 34 out of 210 dividends, so it's still not so bad. But and I have missed some myself, so you could see the ones that I've missed here, all during the volatility of COVID-19, because financials really took a beating. But right now, I consider it fairly safe split fund now. Moving on to the Brompton one. So LBS, the first one from Brompton, is the big 6 Canadian banks and the big 4 life insurance companies in Canada. So it's all financials, really high yield. This one also has missed some dividends. So it's missed 18 out of 176 total. Me personally, I've only missed 8. I think it's 8, right? Yeah, 8. And they've all been in 2019, just like Financial 15, right? Because COVID hit financials particularly hard. But really cool split fund here, very high yield, only has financials. And DFN or FTN LBS have recovered financially, and they're really high right now because financials have done absolutely amazing, just like Inc.UN, right? So they have the same type of exposure. Next one is SBC, also a financial split fund, but unlike LBS that has the big banks and the 4 life cos, this only has the big banks. So this, for me, SBC is my go-to when I want to invest in the big 6 Canadian banks. This is probably one of the safest split share funds of all time, but the safer it is, the less yield you'll get. And it's safe. I say safer because if you actually look at the track record, it's pretty incredible. So it's been around since November 2005. It only missed 4 dividends out of 187, and all 4 were during the 2008 financial crisis. So in 2020, it has not missed any dividends, even with the volatility. So that just goes to show you how stable SBC is. So for me, it's my go-to when it comes to the big 6 Canadian banks. GDV, if I had to choose one split fund to invest in, it's GDV. So this for me is really the best split fund of all time because of its diversification. So unlike all the other split funds I have, they're a little bit more sector specific. GDV is not. Not only is it regional, diversified regionally, but also in terms of sector. So it has US, it has Europe, it has Canada, and it has all sectors. It's not focused only on financials. Financials is actually in second place. Technology is a number 1 exposure at 21% or something like that. So definitely my favorite split fund of all time. It's a little bit newer. It came out in 2018. It hasn't missed any dividends. So this is why they're green. If they're green, it's because I personally have not missed any dividends. If it's orange, I have missed some dividends. So really awesome split fund. Well, the most well balanced, I have to say. DGS is definitely the highest risk, highest reward split fund. It's from Brompton, and it's pretty much kind of the equivalent to DFN. So it's very aggressive. It's Canadian dividend stocks, a little bit more diversified than DFN. It just doesn't have only 15 stocks. It has a lot more, but the unit NAV is really close to $15. So this is a really high risk, high reward fund, and this is why I only have 5K in it, and I'm making an enormous 22% yield on it. So this $5,000 investment has been making me $93 a month. So far I haven't missed any dividends, but the next stock market correction, you could expect that this will definitely start missing dividends. You could actually see from the history, it missed 24 dividends out of 163. So not the worst thing in the world, but it's definitely high risk, high reward there. PWI is a very unique and new split fund from Brompton. It focuses on sustainable power and infrastructure. So we have split funds for financials mostly, but there hasn't been one for utilities or green energy. So this is another dream come true, a very cool new split fund. So it's PWI. The yield is only 8%, so it's not that crazy, but this is a great way if you want to get in on the green energy stocks and have high yield. But green energy, keep in mind, is not only what it has. It also has other stuff like car companies and some telecom, things like Volkswagen, Volvo, Bell, and Telus. Either way, not so bad, right? The last 2 are from Middlefield. So ENS, I'm writing a video on ENS coming up very, very shortly. So stay tuned for that. So ENS invests in Enbridge. It's the only split share fund that I've ever seen that one has only one stock in it, Enbridge, and two, that's actually raised their dividend. Normally they're all set at $1.20, but this one would start at $1.20 and then they actually raised the dividend to $1.56. So I have a couple of videos on Enbridge and I talk about ENS, so check that out if you're interested. But this is where I get my Enbridge exposure. I'm very bullish on Enbridge. It's the biggest pipeline company in North America, biggest energy company in Canada. So I have a nice chunk in here, 25K, which gives me a sweet 253 a month. RS, so this is my new go-to for real estate. It's the newer, I would say, an enhanced version of IDR. It's from the same company, right? The same fund manager, Middlefield, but the only difference is that it's a split share fund, so it uses some leverage. So the yield is a bit higher, although right now the yield is only 6.5%, because like financials, real estate has been the real winner lately, real estate and financial. So it's very, very just like the real estate market going on in real life, right? Property values are astronomical. It's definitely a seller's market. So this fund is really, really high now. Luckily I nabbed it at 14.68 and I'm getting an 8.18% yield, but right now it's something like $18. So you would get a 6.5% yield, and it's still the best thing for me right now to get real estate exposure, because it has the best REITs in North America. So you don't have to buy individual REITs. You could just buy this fund. So I know I didn't do it last month. I briefly skipped through the single REITs and single stocks that I have. This is simply, and I'll go through them this month just to show you guys. So single REITs, single stocks, I only have 11 of them together now. So they are not my bread and butter for my portfolio anymore. I have been going away from single stocks, single REITs, selling a lot of them. And the reason is because they are the most at risk for cutting the income. So I'm an income investor, and during the 2020 crash, back when my portfolio had over 120 stocks, most of them were singles, or half of it was single stocks and single REITs. So a big lesson I learned is that the stock market crashes really impact single stocks a lot more than funds. So I've trimmed them down enormously, but I'm left with 11 of my favorite ones pretty much, and I didn't get rid of them because I'm up significantly on them, so I don't want to trigger any capital gains tax, but I figure it doesn't hurt just to keep a little bit. So I'll go through them real quick one by one, starting with the REIT. So Nexus REIT has been a huge winner recently. It's been skyrocketing in price. What I really like about Nexus REIT is that it's planning to become a pure play industrial REIT. So industrial is very hot right now. It's more of a safer leg of the real estate market compared to retail or office, and Nexus REIT has been absolutely crushing it. So my price is at $7.24. I think now it's almost at $12, so it's absolutely crazy. And with a yield of just under 9, I cannot complain. So hopefully they, I'm going to keep it, because obviously the disadvantage is the risk with the single stocks and single REITs, but the advantage is there's more of a possibility of dividend increases. So the next one, Firm Capital Property Trust, I consider this one, I think of it like a mini RioCan. So it has a little bit of everything, a bit of residential, a lot of commercial, but the commercial is mostly grocery anchored real estate. So I consider it pretty safe. And my favorite part about this one is that the absolutely incredible dividend increases. They've been increasing their dividend by 1 or 2 cents for like 7 years in a row. So this is actually the lowest yielding single REIT that I have, but I have no doubt they will continue raising the dividend or the distribution. But of course, that is just my speculation there. Slate Grocery REIT, this is where I have my biggest weight. So I really like it because, like the name says, it focuses on grocery anchored retail. So, grocery stores in the US. So it's a great way for us Canadians to get some of that real estate piece in the US. And the dividend is really, really good. This is my highest yielding one at 9.53. So really, really awesome. And they too have raised the dividend, and I'm expecting another dividend raise eventually. Slate Office, also from the same company as Slate Grocery REIT. And the last three, by the way, so Slate Office REIT, True North Commercial, Innovalis REIT. These are pure office REITs. So many office REITs took a beating during COVID-19 because everyone went to work from home. So investors got out of office REITs. They made a big mistake, obviously, because office REITs, including these ones, have stayed strong. Their prices have recovered, and I actually added to my positions instead of being scared and selling them. So I made really, really good decision there. But I'm not planning on adding any more. 15K is definitely my limit, I would say. Never say never, but I can't complain with these yields, that's for sure. So Slate Office REIT is off properties in North America, mostly Canada. They also have 2 buildings in Chicago. True North Commercial REIT is pure office in Canada, all over Canada. What's strong about them is their tenants. Most of them are government tenants and very highly rated tenants. Same for Slate Office REIT as well. They really have good tenant exposure. Innovalis REIT is all in Europe. So this one has been making waves. Some good news coming out for this one. So I did put an extra 5,000 in here, like I said in the earlier videos here. So I did sell BGI.UN in July, and I did put 5,000 in ENS, 5,000 PWI, 5,000 in Inno.UN. So I did add a little bit in Inno.UN recently because of the good news. So I have a feeling, don't take my word for it, I can't promise, but it'll probably be a stock pick of the month for September because it's I like the news that they release. So we'll discuss it then. In terms of my single stocks, I only have 5, and these are basically my favorite 5 single stocks that I have left. So Diversified Royalty, which is basically a company that purchases trademarks from various businesses. Their biggest partner is Mr. Lube. They also have Air Miles. So they basically, like the name of the company says, Diversified Royalty, they accumulate the royalties and distribute them in dividends to us, the investors. So when a company is designed to give dividends, it has my attention. And Diversified Royalty had some really, really good news recently. They had cut their dividend from 23.5 cents to 20 cents, but now they re-raised it to 21 cents. So I'm making a nice yield of over 9% now. I'm very happy about that. Bridgemark Real Estate Services. This company is actually owned by Brookfield, and they own Royal LePage. So Royal LePage is a big real estate broker here in Canada. So this company gives the royalties from the real estate brokers that work for Royal LePage to us, the investors. And it's also recovered really, really nicely, making a nice dividend yield. The dividend has never been touched, which is awesome. Decisive Dividend Corporation is a very, very small corporation that buys small manufacturing companies in Canada. They have 5 of them right now. And I was attracted to them because of the name of the company, Decisive Dividend. I mean, of course, right? But unfortunately, they actually suspended their dividend during COVID-19 from 36 cents to 0. But they recently re-enabled it in April at 24 cents. But I'm sure they're gonna put it back to 36 cents. They said so in the latest quarter. They're expecting to do that this year. So when it goes back to 36 cents, I'll change it here. My yield will go from 8.82 to 13.24. So I'm pretty excited about that because my income will go up by about $30 or $35. So really, really awesome. A little company, but it's very, very small. So high risk, high reward, right? Second last one, Exchange Income Corporation. They kind of do the same thing Decisive Dividend does. They buy manufacturing companies, especially aviation companies, and they give out the royalties or the dividends to us, the investors. So this is a much, much bigger company than Decisive. It's over $1 billion market cap, but I only have 5K here. And I'm very happy with the 9.25% yield. I think the stock price is like at $40 or something, and I nabbed it at 24. Last but not least, Automotive Finco. So I only have 5K here. This is another very small royalty type company. They get royalties from financing car dealerships, basically. So very, very small company, very, very high yield at 12.42, as you could see. The dividend has not been touched. So this was really pretty much the surprise of 2020 for me because they haven't touched their dividend. So absolutely incredible. And these are my speculative growth positions, guys. Just full disclosure to show you everything. I do have some speculative growth positions that don't give any dividends. So I have Canopy Growth. I still have 1,000 shares of Canopy Growth, which I haven't touched for years and years. I got it at $6.33. The stock is at $23. So it's been taking a big hit lately, especially cannabis, along with all cannabis stocks. But I'm really, really long term on this. I'm definitely not going to sell any Canopy Growth shares unless it goes to $50 a share, and then maybe I'll consider it. Then I also have a HMJU, which is a leveraged cannabis ETF, kind of like HMMJ that I have, but leverage. So it's even more risky, it's even more volatile, and it doesn't give income. I am down on this one, and I have a small $2,000 position in a Bitcoin ETF, mostly for fun. So that's about it. Now let's go through the totals, guys. So the grand total of my portfolio, so this is my investment, this is my principal, what I put in, it's $708,000. The actual value of what it's actually worth with all the capital gain increases, of course they're unrealized, it's about 820, 840 or something like that. Don't really care though. So on 708 that I put in, my average dividend yield or distribution yield, whatever you want to call it, I think of it like my annual interest rate is at 10.61%. So every year I am making 10.61% on my 708K just in income, just in dividends. And that translates to 62 a month. So if you actually do 62 times 12, you get the annual. If you divide it by 365, you get about $205. And that was my whole spiel of how I make $200 a day. That's basically it. So it's the truth. Total dividends that I've received a lifetime is, I just passed the $100,000 mark, which is cool. So I've literally, on 700K investment, I made back 14.66% of that investment in dividends alone. Stock type breakdown. So you actually see the breakdown of my portfolio. So obviously the bread and butter is really the ETFs, most of which are covered, called ETFs. A nice chunk in split funds as well. Keep in mind that not all split funds are created equal. You have some higher risk ones, some lower risk ones. I consider my split funds I have a lot more lower risk ones and higher risk ones, but there is some risk there. Income funds 15%, and single REITs and single stocks now make up less than 20% of my portfolio. So since I'm not investing anymore in these, I expect the percentage to go lower and lower and lower while these guys get bigger and bigger, especially the ETFs. And you could actually, that's the percentage of my portfolio, but you could actually see the percentage of my income. So here you could see the power of the split funds, right, of the high income they provide. So although they only make up 29.27% of my portfolio, this is where I get a third of my income. So very, very high yield stuff here. So there you have it, guys. There is my portfolio from A to Z. This is everything. So there you have it, guys, my entire portfolio in black and white. Please show your appreciation. Please support me by hitting that like button. I would really appreciate it. It's free for you and it helps the channel grow. So it's a win-win. So if you're a long time follower of my channel, you can basically see that I own what I preach, right? I wouldn't feel comfortable suggesting a stock or a fund without owning it myself. So keep in mind, guys, once again, this is a pure income focused portfolio, really designed for high income, not capital appreciation or growth, even though you will get some of it. It's a strategy and style that really fits my personality, fits my needs, and we absolutely love it. I mean, this is what made us financially independent in the first place, right? At a relatively young age. So again, I'm not against the growth style or the dividend style. The important thing, guys, is that you really invest. That's the important thing. So if ever you want to know more about my investing style, philosophy, my thoughts on a bunch of topics, I do have a bunch of videos out there on that on a bunch of topics. I have a YouTube playlist for all the videos that are associated with strategy and philosophy. So make sure to check out my YouTube playlist. As always, guys, please visit our website, passiveincomeinvesting.ca. That's where you could access my digital product, the Ultimate Dividend Passive Income Investing Package, which I discussed in the intro, which is basically all my years of research put in a bunch of spreadsheets. So it's really a tool designed to help you get started and build your own portfolio. It also comes with sample portfolios for both Canadians and Americans. And right now I'm on version 2. And version 3 will come out very, very soon. And version 3 will have a lot more sample portfolio. So the cool thing about this product, guys, you only need to buy it once. It comes with lifetime updates. So in case I come up with different versions, you will have access to them for free. Also, you could book a one-on-one video consultation with me personally. It's a Zoom call on my website as well. If ever you want me to review your existing portfolio, help you get started, answer all your questions. I'm here to help, guys. So I know many of you love this one-on-one chat or one-on-one service that I offer. I sell out all my appointments rather quickly, so I'm completely booked until October. So I apologize for the delay, but I'll let you guys know once the October schedule is open. Finally, make sure you're subscribed, guys, so you don't miss out on my future content, my future stock picks of the month videos, my future portfolio unveils. You could follow my investing journey with me. So make sure you're subscribed because it's all designed to really help you on your own journey as well. We're also on social media. So we're on Instagram, we're on Facebook. Make sure to join us there. Our Facebook group keeps growing. It's at 2,300 members now. So we have a nice little community where if you have any questions or concerns, or you could put those questions there, and I'm really pleasantly surprised that everyone, like a bunch of people, replies to everything, which is really, really, really cool. I really appreciate that. It's really awesome. The mission of this channel, guys, remains the same. It's to help everyday working people, everyday normal people, to invest on their own, to build their own stream of passive income to enhance their quality of life. So with that, take care, guys. Stay safe. Please get your second dose as soon as you can, and see you next time.